How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond.
Hello everyone, I'm Lorraine Seca, PhD student in climate ethics, working on loss and damage at Paris Sorbonne University and also hosted by the French Development Agency. Welcome to our side event where we delve into the contribution of public development banks into the loss and damage agenda. This is a pressing matter, actually, given that loss and damage has been the central topic of COP until now, with the delivery of an unprecedented outcome to operationalize the new financing arrangements. The new Loss and Damage Fund has received pledges exceeding 500 million for capitalization, with additional commitments still flowing in. This is a strong signal towards climate justice, but that still needs to be implemented on the ground. Throughout the year, discussions within the Transitional Committee raised the importance of coherence and coordination between the fund and the wider financial arrangements, acknowledging, recognizing their role as contributors to this wide mosaic of solutions. AFD and KfW acknowledged the necessity of reflecting on their position in the loss and damage architecture. And in response, they have jointly published a paper to emphasize the role of public development banks in the loss and damage agenda and initiate a roadmap for contributing to this agenda. So the objective of this side event is to discuss the contribution of public development banks to the loss and damage agenda and the core characteristics of this engagement, focusing on pre-arranged finance. The side event is organized in two parts. First, we will discuss how public development banks are already offering solutions to tackle loss and damage through their current initiatives. And second, we will exchange on the gaps of the current mosaic of solutions and how public development banks can contribute to fill in the gaps, notably through improving current prearranged finance. For discussing this topic, I'm very pleased to introduce our fantastic panelists. Barbara Schnell, who is Head of Department for Sectoral Policies at KfW. Mathilde Bord-Laurence, who is Head of Climate and Nature Division at AFD. Komlanvi Moglo, who is co-head of the IDFC facility. Karsten Loeffler, who is co-head of the Global Shield Solution Platform at the Frankfurt School of Finance and Management. François Kayitakere, who is Director of Research and Development at African Risk Capacity. And Daniel Clark, who is with us online, who is Director of the Center for Disaster Protection. Welcome, Daniel. So let's begin with you, Mathilde. Could you please share with us how public development banks are currently offering solutions to tackle loss and damage through their ongoing initiatives?
Thank you very much, Lauren. Do you hear me well? Yes. So thank you very much. I would like to take a step back. 2 years ago, the loss and damage agenda was, of course, high in the COP discussions, but not so well tackled within the DFI world or Public Development Bank world. And some people within AFD had the cleverness to say, okay, I think we must start thinking about it and how it may change our mandate. There were not so many, and I pay tribute to this intuition, and a big thank you to the work of a few people within AFD, notably, and other banks, I'm sure it's the same, who have been very active in helping us setting a framework on the type of activities that we can cover, and also in pushing, and it has been also very important on the German side, pushing how we could also structure the discussion and the dialogue within the countries. So Lorraine, Catherine, Guillaume in Paris, thank you so much. Of course, the debate has been much more active over the past few months. You referred already to the Transition Committee work and the Loss and Damage Fund. It has been also very important within the discussion or related with the discussions in France, notably around the June summit on the new financing pact, which was about how to link development and climate, and how to make sure that no country would have to choose in between financing its climate and financing its development. There is still a lot of work to finalize the framework I was referring to. We've seen the work of the Transition Committee. We know that a lot is ahead of us in defining vulnerabilities, in defining the risk, in defining the mandate of the fund. So these are negotiations. We're not negotiators, but that we will follow very closely, because of course it will impact our tools. What is very important for us as a public development bank is to say that we have started, and we had started, in fact, to work on topics which are now part of this loss and damage agenda, with a view to work on the full spectrum, the continuum of finance in between adaptation, disaster risk management, and all financing tools which are related with this called climate and disaster risk finance and insurance, a vast acronym, CRDFI, and with the spirit of working on everything, preparing, avoiding and minimizing, and then addressing, of course, impacts of climate change. This means, and this is where most probably we will have to progress a lot, this entails working on a comprehensive assessment in each country, in each sector where we are working, of the climate risk of these sectors and countries, and how we can manage them, and then develop and put in front of those risks and of this framework the various financial tools that we will be able to develop. Some are going quite fast. I just came out of a high-level panel chaired by Mia Motley about the climate resilient debt clauses, where a number of MDBs, almost all of them, if not all, confirmed the implementation of this type of clauses, and where AFD also announced that starting from next year, these clauses would be available in 26 countries for covering two types of disaster, for now, storms and earthquakes. So the second not being loss and damage, but earthquakes to start with, but with the willingness to enhance and to have a more complete geographical spectrum and list of triggers over which we need to work on and coordinate ourselves with all the stakeholders able to develop this type of clauses. So we consider that with the work that we are doing, we participate to the mosaic of solutions that you referred to, Lorraine. Of course, because we're working first on the assessment of risk and vulnerabilities. This has been there for a while through our activities on adaptation and disaster risk management. Also because we have the possibilities to provide assistance and capacity building to work with the countries on how they should plan with regard to these different risks and vulnerabilities, what type of investments would be needed, and also to support the governance on this topic, which is always critical, of course, for every sector that topics over which we work, but even more on this type of subject, which is really cross-cutting. We also have a number of projects and programs. We are working on social protection, for instance. We are able to work on topics related also to building back better after a disaster. We support the Global Shield, notably, and earlier we have been supporting the Africa risk capacity. And of course, with our adaptation finance, we also participate into this mosaic of solution through contingency loans as well on DRR and other tools. So we have developed a paper to show this type of work that we can do, hoping that it will help the dialogue happening here at the COP, hoping also that we would not be forgotten, because we can help delivering on the ground, and hoping also that the negotiator would pay attention to the gaps which have been identified in this paper related to knowledge, for instance. We believe we need to cover a lot of ground. If we have only 2 types of triggers in our CRDC clauses, it's because we lack knowledge on how to proceed with flood disasters, for instance, and other types. The other type of gap, of course, is a gap in funding. We need to increase our capacities in grants and loans, and concessional loans, of course, highly concessional loans mainly. The gap also to cover the nexus between the type of work that we can handle as public development bank, but also the humanitarian aspect, which is very important when we talk about loss and damage, and of course some remaining gaps on liquidity tools that we are trying to catch up with.
Thank you, Mathilde, for this introduction. Let's now give the floor to Comme l'Envie. Comme l'Envie, could you provide us with some insights on how the West African Development Bank has designed tools to protect vulnerable populations from climate risks and impacts?
Thank you very much for the wonderful introduction. And I think it resonates very well with us at the West African Development Bank. One of the things that I wanted to say before getting deep into this is that we have a very different scenario, when it comes to the West African region. We do have the climate shocks that we face every day, our economies that are being fed with our farmers, and climate impact that really damages a lot, when it comes to farmers within our region. And then we, as a bank, must come up with some sort of innovative solutions that will not only provide capital, but also will provide some sort of leeway to countries and also to project promoters helping them really to face, these climate impacts that we face every day. It is in that spirit that, the West African Development Bank with the KfW have been working together, and thanks to KfW for supporting us in this way. We've obtained some sort of funding to help us develop an innovative product that we call, it's a shock resilient loan, but we call it PACAN in French, Produit Adapté aux Catastrophes Naturelles. That provides promoters and countries with a bit of flexibility and leeway when they borrow money from us for a particular project, and then they have some sort of climate impact or climate damages, if I may say so, helps them support the loan that they have with us. So for a moment, whilst the impact occurs, the funding or the repayment of the loan is sort of stopped for a moment, and then later on, once there's a sort of solution that comes with the damages, then they start paying back again. So the loan literally, the insurance literally is a parametric one. But then how is that linked with the loss and damage fund here is that we believe whilst the insurance covers that part, then the loss and damage can also help resolve, sort of the issues that they faced. It's been a few years we've been talking about the loss and damage fund. It's great news that, at this COP, this is now, we are now seeing pledges and all that, but we all know how pledges can sort of take time to become operational, and we hope that in the long run, or in the short term, basically, that this authorization of this fund can quickly occur and help us really resolve such issues. But that is our perspective on the West African side, and like I said, we are looking forward to better days. Thank you.
Thank you, Comme for sharing with us this PACAN initiative, which illustrates what climate disaster risk finance and insurance can achieve on the ground. To delve more into that topic, we are fortunate to have Karsten with us, who will shed light on the famous Global Shield initiative launched during COP27 last year. And maybe also, Karsten, in which ways it responds to the loss and damage challenges. Please, Karsten, the floor is yours.
Yeah, thank you so much. The Global Shield Solutions platform and the Global Shield initiative, the Global Shield Against Climate Risk, what is the official title, is part and parcel of the loss and damage debate. So it provides solutions, quite tangible solutions very quickly, exactly to the challenges that the loss and damage debate brings to the surface. And how does the Global Shield does that? In particular, via pre-arranged finance. So that there's pre-arranged solutions. It can be insurance, it can be disaster risk funds that can come in when a disaster strikes, to be able to have liquidity at hand very fast, very quickly, and where the disbursement channels, the payout mechanisms are as well predefined, so that vulnerable populations can benefit to the best in the best way possible. And maybe that's an important point to include here. It's just not kind of the global north flying into the global south and saying how it's going to be done. So it's very inclusive. There's a decent process where the country, the respective country, comes into play. That's called the in-country process. And part of it is a stock take and a gap analysis. And on that, the support package is based. So there's a prioritization. Of course, funding is usually limited. So maybe we can hope for the loss and damage fund that funding becomes more better available, so at scale. But then, say if the request as a result from the gap analysis is on the table, we, at least at the Global Shield Solutions platform, sit down with the respective country in order to frame what the support package actually should be about. So what the priorities are, what the sequencing is, whom to involve, and at the same time, we look into what activities are already there. So what can we piggyback on, and what can we then meaningfully add to that? So it's kind of additional, and it's subsidiary support. Maybe that's a first glance at the Global Shield Solutions platform. If there's more information that you want to have, so just maybe then later in a...
Yeah, I think we will have the occasion to go back to the functioning of the Global Shield. Thank you, Karsten, for this very insightful presentation. I take this point of inclusivity and the design of a wide solution platform focusing on complementarity as very important for delivering effective finance. Having gained such insights into the functioning of risk financing instruments, let's not stop there and take another step forward in our understanding of insurance tools. Through the highly instructive example of the African risk capacity, one of the 4 regional insurance pools created in 2014 that is pursuing a great agenda of innovation in the climate risk insurance sector. Please, François, the floor is yours.
Yeah, thank you. I think here I would start with saying that the issues that were mentioned by Karsten, by Mathilde, and by Komla, I would say that we have a solution already. And that solution is the African risk capacity. And the African risk capacity mechanism was launched in 2014 and is framed as an agency of the African Union, especially the agency, which means that then it gets mandate to operate across the continent and also is close to member states, the member countries. So it becomes then the solution of the member countries. But it happens also because thanks to the support from donors and from our partners, KfW, AFD, and FCDO, and several partners. So that is actually a clear demonstration of this partnership and how it's working. African risk capacity provide mainly sovereign insurance, which means that it's providing insurance to government so that they can get access to financing when disaster strikes. So which means that in terms of pre-arranged financing mechanism, I think this is really the exact concept, and it has proven to be working because so far, since 2014, African risk capacity has paid out to African government more than $150 million. So that those are payouts that went to governments or to government partners. So those are payouts that has helped to support communities that were affected by disasters, being drought or tropical cyclones. So I think this is the demonstration of the concept that the concept exists. Currently, African risk capacity is providing this protection to around 20 countries regularly. We have 39 member countries that have signed the treaty, but the mandate is to cover the continent, 55 member states. At that scale, the current funding, unfortunately, is not sufficient because you can imagine covering the whole continent of Africa, it needs really resources. That's where I think this new mechanism and loss damage should actually looking at scaling up existing mechanism. Scaling up the mechanisms that has proven to be effective, like African risk capacity mechanism. Beyond providing these payouts and this intervention to support communities, there is another component which is equally very important, is building institutions. Because if we want to have a long-lasting solution, if we want to have a long-lasting impact, we need to build institutions. And ARC as an agency of the African Union. I think this is the institution that to build so that the African continent can really own the solutions. In terms of building institutions, so it's about building the capacity in the countries. ARC has been supporting countries in actually 3 main areas of capacity. The first one is understanding the risk the countries are facing in terms of impact modeling. There are not many organizations actually providing such kind of impact modeling on the continent. The second one is about preparing for response, the contingency planning. All the countries present to ARC mechanism have now mechanism to respond to disasters. And this can also be used regardless of the payout from ARC, which means that actually those mechanisms, that capacity can be used also by other instruments. The third capacity building area is about risk financing and risk transfer. So now many countries, now they understand how they can use financial instrument and to transfer the risk to the international market. Because there is no possibility to raise financing locally, you have to raise the financing outside. So transferring this to international market actually provide a mechanism to leverage the small amount that is available for the premium so that we can provide a bigger coverage. So this being said, ARC can become actually the federating instrument, who is federating mechanism for different financing instruments. Today, ARC is providing insurance, but we can also imagine other financing instruments, being a contingent credit or other mechanism. If you want to pre-arrange financing, it means that you need a reliable triggering mechanism. And ARC has built that capacity to provide this reliable triggering mechanism and reliable implementation mechanism. So I will be stopping here in the content.
Thank you, Francois, for sharing this experience with us. We now move on to the second moment of our side event. The way public development banks engage in the loss and damage agenda cannot be limited to capitalizing on existing solutions. But in order to design a coherent and effective response to loss and damage, they must also address current challenges and gaps. And those challenges need to be addressed so that they can provide an effective but also a fair protection to vulnerable people. And this is very important. Barbara, could you please shed some light on these areas of progress and of innovation for public development banks?
Yeah, thank you very much, Lorraine. Yeah, we've already heard a lot of the essential elements which brought this discussion forward. And before I come to the gaps and how we will be addressing them in the future, let me first say that we as KfW, we are also very, very pleased with the establishment of the Loss and Damage Fund, and we see the instrumental role which the Transitional Committee and also Germany and the presidency of this COP have played in getting it going. It recognizes that countries suffering from climate change need support to cope with it. And the fund really has the potential to convene the most capable institutions to provide this support. But it will take some time to become operational. And therefore, the fund will only channel part of the capital and the funds which are needed. So the public development banks will continue to play an important role in supporting our partner countries. So KfW is pretty well positioned to increase its bilateral support for loss and damage purposes. This includes the use of new instruments and approaches we have already tested. So we have acquired, for instance, like Agence Française, the fundamental capacity in analyzing climate risks. And we cooperate with risk insurance providers in that context, like Munich Re. We use their databases in order to analyze risks for all of our programs. And we have invested in a number of funds which actually provide solutions to products which ensure the populations against climate risks. We have invested in risk pools such as African risk capacity, which enable entire countries to cope with these risks. And François has described the way this is done, and I think this is very, very important work. And we have financed efforts in the regions, like in Kerala in India, for example, implementing disaster risk management policies in view of reconstructing, refurbishing critical infrastructure and in a resilient manner, or Honduras, where we fund urban disaster risk management. This includes absorption wells, water retention basins, drainage systems, planting trees in the right places, etc. So we need to scale up what works in the context of these instruments, which works best, let's say. But then we have untapped potential when it comes to disaster risk management and supporting our partners, be it on a standalone basis or as a component of our programs. And pre-arranged finance approaches are very, very crucial in that regard. So we would also support piloting climate resilient debt clauses, which could automatically halt debt repayments triggered by climate-induced events. And we've been working also with BOAD on the shock resilient loan in that context. But we are also looking into the matter how this can be part of all of our loan agreements. However, at the moment, we have to say that we need approval from the German government to go along this route, and also we need to comply with banking regulations. So this makes this a complex matter, but we continue to look into this. And in addition, we see the need to scale up our support for reconstruction and climate-induced migration. And this is not a question of technical complexity, but a question of additional grant funding and also subsidized funding. So now, let me go into the challenges and let me present a way forward in addressing these challenges. So you already described the paper. We were happy to contribute to it along with Agence Française de Développement. This acknowledged the funding gaps and the challenges we are facing, and I would like to mention 4 of them. So I already said for certain areas we have the need for additional funding. We are facing an enormous financing gap for adaptation, and the UNEP Adaptation Gap Report of November of this year has actually pointed out how big it is. For instance, adaptive social protection schemes are very, very crucial. They cover risks of natural disasters for countries, entire populations, and risk pools such as ARC are playing a part in this. However, we need more of these schemes and more comprehensive ones. The way forward is we need to find new sources of funding, and development and climate-related funding is very scarce, so this shouldn't be cannibalizing other funding we apply to these sources. And for to get this funding available, political decisions need to be taken, and this is really beyond DFI's reach, and therefore we also have to work on the political decision makers in order to go down that route. Then we need a better coordination when it comes to the humanitarian development nexus. And there, public development banks have a lot of expertise to actually address the time lag or to address the humanitarian needs in fragile contexts. And these experiences can be applied also to climate-induced catastrophes. There is a time lag between humanitarian aid and then building back better, and public development banks can try or can support or contribute to closing this gap. For this, communities and regions have to cooperate more closely. That's a challenge because when it comes to regions, they have different approaches to addressing catastrophes and damages related to that. And we need to get a more consistent approach in regions, and it's challenging, but it's feasible. And then liquidity in the aftermath of climate-related disasters. Many people say that crisis response is too slow in delivery, and we need to work on that. And our disaster risk financing needs to flow a lot quicker. And so these pre-arranged funding approaches, they play a very, very, very instrumental part in this endeavor. So we need to scale up what works well, shock-resilient loans, climate-resilient debt clauses, etc., and make it apply it to more programs. And last but not least, the knowledge gaps, we need to close them, and they are quite numerous still. They regard risks that cannot be predicted. They regard risks that are not preventable and will result in damage which occurs for sure. Then we have these slow onset events like sea level rise, drought, desertification, and then non-economic losses and damages. So we need to become more knowledgeable on these matters and do more research and find ways to address this. And Global Shield can actually play a very, very instrumental part in this effort. So I've mentioned 4 challenges, and I've tried to sketch the way forward. So let me conclude with this. Thank you.
Thank you, Barbara. I really appreciate your insights in highlighting the ongoing work that the public development banks need to do to respond effectively to loss and damage. I was to end the floor to Daniel, but since we are very privileged to have with us Mr. Ibrahim Adiong, okay. Okay, so I will end the floor now to Daniel, who has focused on the benefits and limitations of pre-arranged funding in addressing loss and damage. In the report Addressing Loss and Damage, Insight of the Fund and Global Shield, Daniel and his colleagues have specifically identified areas for improvement for public development banks' engagement in loss and damage. Daniel, could you please share with us your insight on the explored challenges?
Of course, thank you so much. And can you hear me okay?
Yes.
Can you hear me well? Yes, perfect. Wonderful, thank you. And I think, so you should see some slides coming up in a moment. Thanks also to the technical support people who've made it possible for me to contribute today. At the Centre, we provide advice to countries and international organisations, but we also do quite a lot of research and evidence and have done since we were founded 4.5 years ago. So I'm going to talk a bit about some research from some of my colleagues, particularly Shakira Mustafa, Michelle Pitcher, and Lydia Bull. So we've talked around pre-arranged finance, what it is, and why it's important. One thing I wanted to note is that so we recently launched our flagship report on the state of pre-arranged finance, and in that it's clear that only about a third of all pre-arranged finance that counts as aid or aid-like flows is actually in the form of insurance. 60% of it was in the form of contingent loans. So public development banks are very heavily involved overall in pre-arranged finance as it is at the moment, both in terms of their own instruments, their own banking type products, as well as often financing the insurance products that are counted within that. How much pre-arranged finance is there? Well, we looked at the total amount of crisis financing that comes from aid or aid-like flows, and came up with a figure of around $71 billion in 2021, and we looked at that over the last 5 years. And you'll see over that period, on average, only about 2.2% of that total crisis financing was arranged in advance, was categorized as pre-arranged financing, which is really very low, and that the figure was 2.7% in 2021. Even more frustrating was, of that very small percent, of that 2.2%, only 3.7 percentage points of that went to low-income countries. So the vast majority of that was in middle-income countries or even high-income countries. So that we've got challenges both in the, and I should say a part of that is because obviously a lot of low-income countries are either at risk of or near risk of debt distress, and so can't borrow more. So things like contingent loans are not really possible for them. So you see, for those countries, it tends to be insurance and particularly African risk capacity products, which form the bulk of the pre-arranged financing you find for those countries. Whereas for the more middle-income countries, contingent loans are a much higher share. But unfortunately, we're in the situation where pre-arranged finance is still a very small share of overall crisis financing. And low-income countries are receiving a very, very small share of that. So we've already heard from Kirsten about the Global Shield, so I just want to say a few things. One thing, in the overall objective of the Global Shield, there is that language around, so it's increasing protection for poor and vulnerable people, but there's that language around more and better pre-arranged finance against disasters. A couple of years ago, we launched quite a big assessment of the evidence base on climate and disaster risk financing insurance. And unfortunately, the evidence base is still very weak and very limited. There are only a very, very small number of studies that actually find substantial positive benefits, particularly for sovereign and humanitarian risk finance of the kind that we're mostly talking about now. There's much more evidence on the sort of household insurance or agricultural insurance or homeowners insurance, but there's still very limited evidence. And there are lots of examples of schemes that have been launched with good intentions where they've had one critical flaw, and that one critical flaw has led to the scheme not having impact. And there are lots of different ways where these schemes can fall over. So I think that ambition within the Global Shield to learn from the innovations over the last 15 years or so is really important. And I sort of congratulate the Global Shield for that. Delivering on the better. So it's still too, obviously the Global Shield is still relatively new. It's building on a large program of work supported by Insure Resilience and others, but it's still relatively new. Too early to tell whether it's going to be a success, but it's important to recognise there has been substantial progress made since the last COP, and these things do take time. In terms of the Global Shield going forward and how to think about it, I think there is a real potential for the Global Shield acting as that focal point for providers of pre-arranged financing in the loss and damage mosaic. I don't see any other sort of credible actors potentially be able to take on that role, particularly learning from evidence of what's worked, what's not worked, and building on that for making sure that the best possible solutions are supported. So strengthening the evidence base and strengthening best practices. What about loss and damage overall? So just got two more things I want to say. One around how to think about pre-arranged finance in the context of loss and damage, and then finally on going back to public development banks, if I may. Firstly, there is a real knowledge deficit, both on the demand side and the supply side in terms of instruments. And you see a lot of innovation. It's great to hear from the panel about these pause clauses and other instruments that are being developed. The BOAD instrument, for example, it's great to see continued innovation. But this is still an emerging area, and often development organisations as well as countries don't have the expertise to necessarily know exactly what they want at what times for what solutions. So I think there's still more to learn about what the right tools are in the right places. Secondly, in the context of loss and damage, obviously slow onset losses and damages are a critical part of that, and there's it's still unclear what role pre-arranged finance can play in that. Obviously, in domestic settings, pre-arranged finance can play a substantial role, but that's because sovereign governments typically stand on the hook for those long-term losses, which that's typically unfunded commitments by governments, as opposed to the loss and damage fund, which is a funded commitment, which is much more difficult to take on pre-arranged finance for those kind of risks. Thirdly, triggers. So what counts as an event? What counts as a shock worthy of triggering finance as a contentious issue? most colloquial definitions of disasters are not objective in nature. So by trying to sort of convert that into objective, measurable risk, there's a risk that stakeholders involved in the process might have different opinions on what constitutes a disaster, what constitutes a shock. There have been lots of issues over the last decade with triggers being rolled out that have led to disappointment. They haven't triggered when people have wanted them to or thought they should, or they have triggered when people thought they shouldn't. So I think there is still much more work to be done on developing triggers that are really fit for purpose, as well as communicating triggers so that all parties and all stakeholders have an understanding of the fact that these things are proxies. They're not going to be perfect, but they can be pretty good proxies. It's slightly embarrassing that we're still at the situation where most triggers for prearranged finance are not made public, which is a bit odd, given that they're mostly, the development are mostly funded by public money. Next, there's a question around whether prearranged financing funding is new and additional or not. So we heard yesterday from Luxembourg announced the contribution to Global Shield, making it very clear that this is new and additional. This is a strong request from climate vulnerable countries that loss and damage financing is new and additional and does not gouge funding for mitigation or adaptation. Next, one of the questions and one of the challenges is around ensuring that fast money leads to support for the most affected or potentially at risk of being affected people. We've seen over the last decade or 15 years of disastrous finance, there is even if you make fast payouts, that doesn't necessarily translate into fast action, because fast action often requires shifting a culture within a line ministry to take preparedness seriously and to actually have things up and running to be able to disperse and to overcome those political bottlenecks within governments around who gets to decide which line ministry gets the money, and which part of the line ministry and which project, which program, which part of public services get to receive the money. So there is continuing challenge in that. And then finally, on transparency and accountability. So we've been doing some work on this recently. I mean, another paper, in fact, by Sophia Swithin, we launched earlier in the year around accountability when it comes to prearranged finance and different. There is still a lack of transparency over what public money is being used to invest in for prearranged finance, and there needs to be improvements in accountability as well. Climate risks are not going to be managed. Public development banks can help, but these climate risks are, in terms of proactive management of those risks, that is best done at a local level, locally led risk management. And it's very difficult for that to mesh into this international prearranged finance without transparency and accountability of local populations. So then finally, promise, what does this all mean for public development banks? Well, firstly, I mean, going back to that 2.2% figure over the last 5 years, only 2.2% of crisis financing being prearranged. It really is possible to increase that and increase that pretty rapidly, particularly for public development banks that provide substantial crisis financing when crises are actually occurring. So it's great that the UK recently in their white paper announced commitments to increase the amount of prearranged finance. Germany last year on the humanitarian spend made big commitments, and obviously partners to Global Shield have committed to increase their share of prearranged finance. But I think it would be really helpful to have some better tracking and monitoring, because often the tracking is only tracking insurance related products, whereas a lot of the big financing is coming through contingent loans. So we'd encourage public development banks to establish a baseline, work out how much prearranged financing there is, and monitor it, and maybe even set targets. And this is something that we will be setting up a community practice for this, and very happy to support, on the back of the prearranged financing report, which we're going to be doing every year now. Very happy to work with public development banks for them to help understand the amount of their crisis financing that's prearranged, and to help inform their decisions about potentially targets. Secondly, we've heard again in this panel around new instruments, which is helpful, and partnerships. So we heard from African Risk Capacity about their instrument, which is not, they're not a public development bank, but they're a public organization. And there are obviously options for public development banks partnering with other organizations, particularly organizations that are development insurers, for example, on using their instruments to supplement the list of instruments that public development banks have. And I think the more instruments that public development banks have, the more able they are to offer the best possible solutions to their clients. We're not there on the instruments yet, but so it's important to sort of use them well. And then, to note also that from a political perspective, there are often incentives not to prepare for tomorrow's, for the disaster that hasn't happened yet. It's often difficult to find funding for the disaster that hasn't happened. And, we have seen, even when prearranged finance instruments are available to countries on fairly concessional terms, that countries often don't choose to take them up. In fact, there have been some examples where countries have been offered fully subsidized insurance products and have said no to them. And I think it's important to understand those demand-side constraints and incentives are there, and to reflect on those to better improve the instruments and the offer to countries. But to note that, for example, the World Bank in their main line of contingent credit, they have essentially a 4-for-1 offer on that for the poorest countries, for IDA countries, where a country only has to use $1 of their own IDA envelope, and they get an additional $3 that tops up their country envelope. So getting these incentives right for countries can be helpful to get uptake. So that's on the scale where I think it's possible to do more. And then secondly, on this point around quality, I think we don't yet know where the best places are to deploy prearranged finance. Prearranged finance isn't a panacea, but it has a role. What are the best places to deploy it? Is it in providing quick liquidity for governments to avoid liquidity crunches, or actually is it for providing financing for particular public services to ensure they can maintain or scale up in the context of a disaster to better support populations? And as part of that, addressing those issues around accountability and transparency and responsibility for risks within governments and that sort of public financial management aspect. So we're still not there in understanding how best to deploy these instruments, but I think it's really important that when implementing prearranged finance, to be clear what is the objective of this, and then sort of coming back to then saying, did it deliver on that objective? Triggers talked about. It's really important to think about triggers and try to get them so that everyone is comfortable and no one is surprised, and they sort of help to build trust. You don't want to pay too much for your prearranged finance, and when you do the economic analysis of this, you need to think about the full opportunity cost of those instruments. So, for example, a contingent loan may look like it's cheap, but if actually you're withholding concessional credit from a country that could draw it down earlier, it can actually have a very high opportunity cost. So part of the reason for the World Bank's CAT DDO being their line of contingent credit having this 4-for-1 offer is because it's concessional credit. It's actually that it has if it didn't have the 4-for-1 offer, it would have a very high opportunity cost for countries. So countries wouldn't be drawing it down, I would imagine. So really thinking about cost effectiveness, including the sort of full economic cost, particularly for banking-like instruments. And getting the money out right, getting that link between the money coming into governments and the money going out to support public services or directly supporting people. And then very finally, enhancing transparency and accountability. I think public development banks are there. They're partnering with countries on their development journeys, particularly in the context of climate risks and increasing climate risks. Public development banks can't solve these problems themselves. They're not theirs to solve. They can provide substantial finance for them, but trying to get the right transparency and accountability right within public development banks instruments set is going to be critical. And I think we're a long way away from getting that right at the moment. I think that this is an area where I think there's a real potential to do an awful lot more. If you think about insurance, the history of insurance is a history of, lots of issues with people being sold products that weren't necessary, they couldn't rely on. And then the emergence of the insurance regulator as an organization there to protect consumer interests and doing lots of very boring but very important things to try to ensure that people understood what it is they're buying and that the products deliver fair outcomes. And I think we really need to think about the same principles when it comes to these prearranged financing for countries. It's not enough to sort of let a free market between or sort of innovation without thoughtfulness going forward, because I think we could very easily end up with the wrong products. So trying to get accountability right, and improving accountability within countries and within public development banks for these instruments, and really forcing there to be steps in the process, challenging before an instrument is agreed, challenging and providing transparency is going to be really critical. Back to the room.
Thank you, Daniel, for this very insightful presentation. I hear very strong messages for public development banks in scaling up pre-arranged finance and working on current challenges in providing effective tools. I think it's very interesting what you say, Daniel, really echoes also what Francois and Barbara have told us about, like building capacity, building strong institutions, and also the need of really increased finance, but at the same time, as you mentioned, Barbara, it's also a political decisions that sometimes can be beyond development bank capacity, but we take this as very strong points to increase and scale up our support. We are very honored to have the president of ARC with us, so I will let him the mic for comments.
I have not been promoted to president yet, but I'm working on it. And my apology for interrupting your proceedings. And I hope my board member, whom I call my boss, Barbara, on the panel will not hold it against me at the next board meeting. Let me make a couple of points. Number one, things I believe as a community, we should certainly celebrate on the progress we've made so far and raise a couple of concerns that I believe collectively we have a role to play in making sure that those concerns are addressed. I think the mere fact that we talk about the Loss and Damage Fund demonstrate that global solidarity worked. And if we pull our hands together, certainly we can deliver on behalf of the developing countries, as opposed to staying on what I call the blame game, and we find ourselves still talking about loss and damage. And while we do so, may I remind you, there's a lot of people in Africa who are suffering because of climate change. So that human face, in my view, should inspire all of us to make sure we are pragmatic, we are tangible, but we also we're impactful, as opposed to remaining at the global level. There's always a concern also to keep the momentum in this global solidarity, not just at the COP, but after the COP, we should continue at least to continue coordinating among ourselves, to make sure we can deliver beyond just loss and damage, but do more in building resilience in European countries, Africa in particular. I think some of the concerns that I want to raise, which all of us know, have said on the panel. Number one, on the commitment that's been made so far here, you know very well the demand is bigger than what we heard so far in terms of the numbers. So the question, how do we make sure that after COP28, the fundraising will continue, the commitment will continue, the pledges will continue, so that we get closer to actually what we need to meeting the demand with regard to loss and damage, particularly in Africa. And that, I have no doubt, all of us combined can continue to make sure we will push our leaders to continue the commitment that's been made so far. I'm also mindful beyond just loss and damage. Some of you were in bilateral and multilaterals. You've been investing in building resilience before we even talk about loss and damage. And my hope is that kind of commitment will continue so that it will complement what we got for loss and damage. Now the concerns are known. Governance. With the existing climate fund, there's a lot of frustration, I'm not going to name any name, where the procedures are so cumbersome, the money is not actually available to where it's needed. And that always made me talk about what I call the AAA of climate finance: accessibility, availability, and affordability. There is no point of having money that we hear in the billions, but they're not accessible to us. And I think all of us should learn from previous funds, GCF included, to make sure at least we can soften the procedures in a way that we focus on the demand as opposed to on the procedures, which I hope we can certainly push that envelope. I think second concern is there are existing organizations, Global Shield included, and my organization included, They've been doing this for a number of years. They can certainly be utilized as a leverage to make sure we can expedite implementation as opposed to reinventing the wheel. So the mere fact that we've learned so much of what not to do, I think it's important an organization like ours that's been involved in this for a number of years is willing to learn from this experience. That's the reason why I'm proposing to Global Shield. We began to think about life after the COP and what I call COP, post-COP 28, which we can all come together, talk about what is the demand, what do we need to do to coordinate better, but more importantly, how do we expedite implementation? I have no doubt we can work together on that after this. I think the last concern that we should all be mindful of, the question is, one thing to get the money, but what do we spend the money on? And from my experience, at least from my understanding of the demand, we should do more in mainstreaming early warning systems, risk profiling. You cannot address a problem unless you know the magnitude of the problem. And today's advancement in technology and innovation is such, as the director of R&D sitting there, we can make sure that this information is available to policymakers so they can make informed decisions. So I hope that would be also part of the conversations. It is important to understand we need more than money. We also need technical assistance, we need capabilities. And the level of advancement in the West that we can leverage on certainly should be part of the solutions. I think second, capacity building and contingency planning in the African governments, it's important. Many countries, I used to be in the government in the previous life, where the culture of disaster management is not embedded in public policy. So what the Africans are asking is African solutions to African problems, required to build sustainable capabilities so we can do it on our own. It doesn't necessarily mean that we don't value global solidarity, but it's important we have that in mind. Last point I want to make, although we're in the business of parametric insurance, that's not the only answer. There are solidarity funds, contingency funds, social protection funds. What we're saying, loss and damage can help us to diversify the offering when it comes to the respond. What's important here as the key was rapid respond. In the business we're in, every second kind of disasters. So if you get too technical, you may actually lose some livelihood. And that's why having insurance solutions, other innovative financing, and you deploy them as necessary, is going to be extremely critical so that we can have a diversity of solutions. And that's why it's important we continue to use innovation and come up with some new product as well. I think last but not least is coordination. I'm hearing some very great initiatives that are coming up. The worst could happen to us, particularly in Africa, is a duplication of efforts. And I have no doubt with the conversation we're having is Global Shield and other players. You know, Barbara sits on my board, and I bet at the next board meeting, she will ask me, what are you doing with other initiatives? So you can coordinate better and deliver on behalf of Africa. I wanted to come here to express the commitment, the support of the African Risk Capacity, which I have the distinguished honor of leading as the Director General, to demonstrate that we want to be part of the solutions. And as we say in the African Union, African solutions to African problems, but open to partnership to work with all of you to deliver on behalf of those we're expecting, have very high expectations from us. So on that note, thank you very much for inviting me. Thank you.
Thank you very much. I think now is a good time to try to have an open dialogue about all the issues we have been tackling. And I will also would like to open the floor. But first, I will have a few questions of my own. So my first question maybe will be for you, Karsten. Daniel pointed out challenges that the initiatives like the Global Shield may face in terms of building trust and transparency, notably regarding the use of triggers, but also the need of transparency, considering what pre-arranged finance can do and what it cannot do. So I would like to have your insight on how the initiative is currently considering and aim to address these challenges. And after all, I can also extend this question for AFD and KFW.
So on the transparency side, say there will be public reports about what we do in the first place. But even earlier, I mentioned that it's a very inclusive process. And that means that the program that the Global Shield Solutions platform is going to finance is very close to the respective countries' requirements. And even on a governance, in a governance structure, the country has a seat and a vote together with us as the implementing partner about what to do and what not to do. So meaning even on the technical level, the country will be involved so that there's as much buy-in as possible. And of course, we will always try to get a broad consensus on what it actually means when it's getting to implementation. So that we then have the respective government representative in the room when we deal about, okay, say how it's going to affect vulnerable populations, what are the payout mechanisms, so how is the money then flowing in the end. And that means transparency to stakeholders, and the Global Shield is a transparent initiative in the first place. And when it comes to the technicalities, we have at the Frankfurt School of Finance and Management now almost 5 years of experience with the Intra-Resilient Solutions Fund, where there's a very similar question as to how to set triggers. So what does it mean? Where are the risks of setting triggers to avoid basis risk to the extent possible? There will be always some basis risk remaining. But there's a huge resource that we can build on. And I think that's the really great advantage that we have in implementing the Global Shield Solutions platform.
Thank you, Karsten.
Maybe to add up, what is going to be really important is that all our efforts are well coordinated. And you can't be well coordinated if you are not transparent and accountable. If you take the example of those famous CRDC clauses, imagine a case where we don't have exactly the same analysis on the event and that it's triggering for AFD and not for KfW. That would not work. So, I mean, it's just an evidence that we need to be clear and to all together to be completely transparent on our tools and the triggers that we want to use. So that's one point I wanted to add. The second is that we will need a lot of knowledge. I mean, we heard that there is already a lot. I think all the presentations have shown it very well. We will certainly very much also rely on the work of the Global Shield, notably for the national dialogue, where then the question of transparency and accountability will be embedded into how it's implemented in terms of governance, also into the structure of the in-country processes, which is as important as our own transparency and accountability.
Thank you, Mathilde.
Yeah, maybe I just want to add that if you're not transparent in how you base your decisions after a catastrophe for a payout based on the data you have available, then you lose immediately your client's trust. And insurance solutions, they live based on diversification of portfolio. That's key. The more portfolio you have, the better you can ensure your clients long term. And therefore, transparency is really key for this whole concept to work. Otherwise, if we lose trust of our partners in offering solutions, then nobody will be served in the future in the long term, and that would be disastrous.
Yeah, for sure. Maybe, François, if you have some insight also on how the African risk capacity is tackling this issue of building trust through transparent triggers, and also how type of risk design products do you see need for support for improving risk pooling tools?
Yeah. I think the whole mechanism of ARC has been built actually around this transparency and building trust with member states, especially because when the mechanism started, it was difficult to convince African governments that the mechanism will be transparent because there was some suspicion that would be somehow biased toward the insurance companies. But in the long run, what ARC does is to have to involve completely government officials, experts in the country. So we have a technical work group within the country so that they really trust the model. The second thing is that all the African risk capacity models are open and can be scrutinized by anybody. So this, I think, has contributed to building trust with member states. And that's also what I think is a success factor on building long-term relationship with countries. So that's why we try to keep this long-term relationship instead of going to kind of shopping or startups mechanism. In terms of the gap, so the continent is huge. So we are trying now to diversify the product, as Barbara said. We're providing coverage for drought and the tropical cyclone. We are stepping into to provide also coverage for flood risk. But there is still a need of having the capacity, modeling capacity, especially for risk like a flood, because it's a very complex mechanism, and when you have to do this across the African continent, it's a huge task. So I think the mechanism like ARC, they need additional funding to build this capacity, and also this modeling exercise is benefiting to others as well. So countries are using this information also for their own risk profiling, and also other organizations can still use the information for other purposes. So I think it's an investment that will benefit everyone, having the capacity to really assess the risk. Anybody who has been working on risk assessment across the continent knows how difficult it is because there is no systematic data collection, so you need to model the impact.
Thank you, François. I really understand this point. Comme l'envie, I wondered if the initiative you exposed, the PACAN initiative, if at the West African Development Bank you see any issue of coordinating this type of risk disaster finance with other type of solution and response that address the full spectrum and the full continuum of risk, maybe like a disaster risk prevention. So how do you see the coordination with risk finance and also other tools for reducing risks?
I think, thank you. I think we are at our first sort of product that we are testing with ARC actually. And with the support of KfW, as I said. But what is interesting here is the sharing of experiences from everyone. And remember that we are the IDFC, and we have a lot of members that have sort of tested this sort of product. So we promote cooperation within the IDFC, and shared experience will be used as part of our tool really to complement the missing gap, if I may say so, within the PACAN product. So far, the coordinating it has not been a disaster. It's been a very interesting sort of learning curve for us because we've had experts from KfW and experts from, I think, Munich University that have been working with ARC and have gotten so much experience in this, and they've been working with the operational teams, and also we've involved the countries that we cover, members of the countries that we cover, so that they understand exactly what it is and how it functions and stuff like that. But internally, when it comes to risk assessment as well, we have begun mainstreaming climate in all of our operations. Before it was just on certain operations, but now it is all of our operations. So the risk aspect is being taken, very seriously. And I think if there's any sort of missing gap, then I think we have the right tools at our hand to deal with that. Thank you.
Thank you so much, François. Maybe I will have for you, dear panelists, a more general question that may also be of some personal interest for me. This topic leaves us very connected to the question of risk modeling, actually, and risk finance. It regards the interconnection of the issue of pre-arranged finance and the loss and damage fund. Discussions have been initiated very recently on the use of triggers and physical risk models for allocating resources within the loss and damage fund. It is also something that the transitional committee has underlined. And I personally think that it's very interesting because it really shows how fruitful the interconnection between the pre-arranged finance and the loss and damage fund can be. Using these triggers, we have experience in forecast-based finance, and translating this experience into loss and damage fund can be very interesting. So I would like maybe to ask if you have some, do you think of this opportunity and this interconnection between sometimes initiatives that have been sometimes pitted against each other. So I think this can be interesting to have your insight on this. Maybe Daniel, if you want, or Barbara.
Yeah, I'm very happy. Yeah, very happy to start off. I mean, it's a little bit like one of these big fundamental questions you have around discretion versus rules, and we see this a lot with finance. You see this in central banking. You also see it when it comes to risk. Do you want to have discretion? So you only know when a disaster is a disaster, or you only know when losses and damages have occurred. You have to see it to be able to know. Or can there be some rules that you agree beforehand that may either precisely say what you're counting, or may be a proxy? And I think the big innovation that has spawned a lot of this pre-arranged finance for sovereigns is this idea of using proxies, using parametric indices or some kind of index as a proxy for whether something really big and bad, some sort of shock has happened. And I think there is, just from an efficiency perspective, there is a real role for proxies that may not be perfect, but may be good enough. In particular, because if you leave everything to discretion, everything tends to be quite slow. Response is slow, and if response is slow, then it can can be less effective. So there are lots of questions the loss and damage fund is going to be grappling with, and obviously the transitional committee has been grappling with. If there's a part of loss and damage funding, which it looks like there will be, which is around response to events that will occur in the future, then having some kind of proxies that enable fast response will be critical, because there is a trade-off between the speed, the accuracy of your rules, and the cost of your rules, and you're going to have to make some compromises. In the same way as the world has learnt over decades how best to support people in extreme poverty from escaping that extreme poverty, there are always issues of targeting. You can't perfectly target those individuals, but proxies are helpful, and I think we'll find the same with risk. Proxies are helpful. We need to be serious about trying to make the proxies as good as possible. We need to have, we want our triggers to be good, and they're not going to be perfect, but they're going to be part of the solution.
Thank you, Daniel. I would like now to open the floor and invite our audience, if they have some questions, to feel free to ask some. Yes.
Thank you. Hello, I'm Nicholas from the Anticipation Hub, which is a knowledge and exchange platform hosted by the German Red Cross, the Federation, and the Red Cross Red Crescent Climate Center, and works to scale up anticipatory action. And I think, first of all, this is a super fantastic panel. I love it. It's really great. It's music to my ears that I hear, the development banks are now looking more how they can contribute to loss and damage. So congratulations to that. And we heard a lot about coordination, and I was wondering if there are plans for a joint development bank strategy to coordinate the investment. Say, for instance, if there's any attention that a bank focus on a certain instrument or a certain country, region, or specific activity. For instance, one more on system building, the other even, for payouts or money out systems. And keen also to learn more, since this is a big topic in the discussion on the loss and damage fund, on the planned attention on the accessibility. So if there's a possibility, for local actors to access these potential funds. And I'm asking this also because I said I work for the Anticipation Hub. Anticipatory action is a loss and damage approach that links, triggers to action plans. Is a money out system, as Daniel would say. And it requires a lot of upfront investment, basically echoing a bit what the Director General of ARC said, investment in forecasting capacities and plans and so on. And I'm just keen to more how we can here come together across sectors. Yeah, thanks.
Thank you.
We take another?
Yeah.
There was another question in the back.
Please, feel free.
Hi, I was wondering, so my name's Tom Mitchell, I'm from the International Institute for Environment and Development. I was wondering what the panel's views were of debt for loss and damage swaps. Thanks.
Thank you.
Thank you. I start? It's okay. In terms of coordinations, I mean, you heard my message just before. I think without coordination, that would be a real problem. There are many ways which can help in terms of coordination. The Global Shield is certainly a place where coordination is going to happen. In many instances, I mean, in between, given the size of the partnership, the number of partners involved, and given the structure, including in the in-country dialogue, the coordination we rely very much on the Global Shield. By the way, I forgot, but Catherine reminded me to confirm or to re-announce that France will, through AFD, provide 20 more million next year to the initiative, so reaching out to 40 and hoping that it will continue years after years. So this is one part of the work which will help in terms of coordination. You are in an IDFC pavilion, so I think it was already explained. Our role is to try to coordinate also at least our analysis, our tools as members of this club. So we will use this the common work that we do, the share of practice, to coordinate also on tools and triggers and so on. And there is another level, another coalition, which is the Finance in Common initiative, who has launched yesterday an innovation lab. The first work of this lab will be to work on the CRDC clauses, so on the climate resilient debt clauses. For a start, I think we can try to ask a lot to this lab. The Finance in Common coalition, you may not know, is a movement gathering the 530 public development banks around the world. So here you have 26. You have public development banks everywhere in the world. So here you have 26 members of the IDFC, but in fact around the world you have 530, including the MDBs. They are part of this coalition and have hosted over the past 2 years the summit and the work stream. So this innovation lab is in fact actually launched by the IDB, who has been the first to implement those climate resilient debt clauses. So this is another part of a piece of work which can help in terms of coordination. Regarding access to finance, it's not only sovereign here. I mean, a lot of it is going to be through the states, but there is no reason why contingency clauses cannot be used in other type of tools and with other type of clients. Insurance is not only for countries. Insurance is not only an industry, by the way. It's also a principle for which you try to differentiate between on how you finance certain type of events between public and private. So these are tools also which are going to be and should be very much accessible. And in addition to that, we have to work a lot on inclusivity to make sure to reach out to the most vulnerable people as fast as possible. This is certainly a large part of the work. On debt for nature, and then maybe you compliment on everything, or you want to compliment on that? I don't know. Yeah.
Yeah, actually, in terms of coordination, I think the initiatives we have in place now all ask for coordination. No? Global Shield has this idea, the Loss and Damage Fund in the end as well. I mean, the way it is going to be set up, I think, is also a learning from the Green Climate Fund, and to have it quicker being operational, and I think this is why they probably chose this route now. So I think learning from existing schemes when it comes to triggers is crucial. We have already talked about that, and I think that really asks for a lot of know-how transfer, etc. When it comes to ensuring our respective portfolios, then of course you have to look, okay, which partner country are you working with? What are you funding there? And how can this come into play when it comes to the question how to ensure that against climate risks? So I guess some institution-specific aspect is always there. However, I guess we need to cooperate. Debt for loss and damage swaps. I'm pretty accustomed, and I have come across the debt for nature swap idea, where you provide an incentive for a certain country to invest savings from a restructuring of debt into climate or biodiversity-specific areas. When it comes to debt for loss and damage swaps, maybe you want to elaborate a bit on the concept, but I mean, that would only be available. I mean, those funds would only be available after a disaster has caused loss and damages, so that's not the same concept like you have a country invest in a certain trajectory, or so maybe help me a bit on the concept.
So at the moment, when a country experiences the impact of a disaster, the first thing that they have to consider is, are they paying back their debt, making their debt service payment? So you've got your climate resilient debt clause component, of course, which gives you that option. But what about actually, rather than having the climate resilient debt clause, you created a mechanism to actually reduce the stock itself? The problem that you've got with a climate resilient debt clause is that the total cost of the loan is likely to increase, partly because of the credit rating situation. So we can't just rely on a climate resilient debt clause, and so I'm suggesting that we pair that with a stock reduction that actually then gives you the chance of leveraging, in some ways, the money in a different way, and in a way that actually gives a country a fighting chance, rather than essentially extending the problem.
Yeah, I guess as long as you talk about purely sovereign debt, then it's a political decision. If a bank has provided the loan, then you have regulatory issues to deal with. So I think it's not to provide a very easy answer on that one.
I think Danielle has a point also on that, so please, Danielle, the floor is yours.
So, I mean, I think we should be thinking about all these ideas. I'm a bit nervous about that. And I'm sort of thinking about countries where, for example, when there's a big drought or a big agricultural shock, the response to government is to let farmers off loans to sort of debt relief for farmers. I think the politics of this can end up very messy, and the incentives of this can end up very messy. And I think one of the challenges is you're essentially asking banks to sort of act like insurers. I think the idea of the pause clauses being positive net present value, I think, is a really good one. But there's a question about how the banks themselves will manage those capital requirements of relieving debt automatically when something happens. And I think that essentially, I think that the risk would need to sit on public sector balance sheets somewhere outside of public development banks. Then I think there's the issue of speed. So we have lots of initiatives when it comes to shock response that have had good intentions but have been very slow. Even the World Bank's crisis response window, which was $3 billion until fairly recently, over the decade up to COVID, took 398 days from the date of the shock to the first dollar flowing from it. So these things can be absurdly slow, and we know that speed matters when it comes to sort of shock response. And then finally, I think there is a more general question around loss and damage funding and whether the money goes to countries and that's it, or whether there is some accountability over it, the money supporting people who've been affected by the shock. And I think for sort of debt swaps for loss and damage, there'll be a question around what if the intention was this was to be money that goes directly to government, that's fine. But if the intention was this was also supposed to be supporting the most at-risk people, then it may be helpful for there to be, that may be difficult to implement through an instrument is essentially a sort of essentially the equivalent of a liquidity injection for government.
Thank you, Daniel. Mathilde, I think you have a point also to
add. But I think Daniel explained it well in a way. I mean, here we discuss what are in the hands of PDBs. The points you raised to me is more in the hand of the Club de Paris, and because it deserves a thinking and working on the debt sustainability of these countries, incorporating climate. This was not sufficiently done until now. I think we all acknowledge that. The work should really start. It's quite probably urgent. I think it's progressing in the mind of the members of the Club de Paris. And to me, the answer will be stronger, larger in this arena than through us. So I will support this work through this type of dialogue.
Thank you, Mathilde. I see we are already past the time, so I would like to wrap up the session, and thanks all our dear panelists for sharing all this value and experience with us today. Thank you.